Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for September 18th of 2023. Well, after being away from Charts and Chat for a couple of weeks, we certainly have a lot to catch up on, a lot going on, a lot to talk about today. We're going to start here. These are the items in the news, and this is an assessment by Goldman Sachs on what the impact on the economy might look like for those three key things that are in the news right now. Obviously, this month is a big month that we have the resumption of student loan payments on federally guaranteed student loan debt. You can see the impact there is about a negative 0.5% to GDP, and we've got some other slides to talk about with regard to consumption on the part of the generation that is most likely to be paying these student loans back. Also, we have the looming government shutdown. We have a huge political impasse in Washington, a very hard line approach by several factions, and it does look like that we're going to have a limited government shutdown. You can see here the impact here is maybe 0.2%. If it's fairly short term, and that's the consensus right now, but honestly, who knows? But if it does go more than, say, 2 to 3 weeks, then Goldman Sachs here has predicted it would have a more pronounced, like 0.5% or so impact on GDP. And then also we have the ongoing United Auto Workers UAW strike that has impacted actually all three major auto manufacturers, which is extremely rare, actually. The impact there less pronounced depending on how long this goes, and that's really the same for everything, right? Not a huge impact unless this thing kind of stretches out. They are looking for some significant wage increases, and ones that would honestly put the major auto manufacturers in a real financial pickle for their own fiscal situation. So anyway, right now, looking at a kind of a little bit more somber picture on economic growth coming off of a quarter in which GDP should actually be very, very strong. So I want to kind of level set us here on where we are with economic growth forecasts and where we've come from. We've got real GDP growth in the dark blue. We've got personal consumption expenditure inflation in the red line. You can see that has come down, as we've been talking about for many, many months, as well as the unemployment rate, which has remained fairly sticky in almost historic unemployment levels. But you can see here as we kind of take these actual numbers and kind of stretch them out into forecasts. And this is a Federal Reserve Bank of St. Louis. This is their own assessment. And obviously, there's a lot of estimates out there. But from their point of view, certainly see inflation continuing to come down and eventually, perhaps by the latter part of next year, getting a little bit closer to their 2% overall target. You can see, on the other hand, unemployment picking up a bit, but not too bad. Maybe topping out third quarter of next year, about 12 months henceforth, about 4%. So not a whole lot of erosion in the labor market expected on the part of the St. Louis Fed. And then also here we've got real GDP growth, and that is expected to continue to be positive, but maybe decelerate to some extent. Here we have another look by KPMG Economics, looking at global growth this time, not just the U.S. And so, as you look out on the opportunity set on the global stage, over, perhaps the next year or so, not really looking yet into 2025, but below trend growth is kind of on tap here. And you can see in that red line the decade-long average from 2010 to 2019. So again, not catastrophic, not terrible by any stretch, just a bit below trend. Here we have the Conference Board in their Global Economic Outlook, which is very timely, comes out in late summer. we're looking at this here now, and this is their own assessment, and you can see how the trajectory is. You see global in that dotted black line there. So, here we are in the third quarter, kind of the end of the third quarter of 2023, looking for a relatively strong number in the in the U.S. But if you look at mature economies overall, perhaps sliding into that second quarter of 2024. So, the U.S. is really kind of the strong bastion over the global stage right now. Rest of the globe kind of slowing down. You can see emerging and developing economies, kind of treading water. So, when you look at it from an investment standpoint, in terms of real GDP growth, emerging markets seem to have some value here. Certainly, treading water is better than the volatility that we're seeing in the more mature economies. But one thing to note here is that towards the middle part of next year, you see that noticeable uptick here in the economic growth prospects for mature economies. And that's something that I think is really built into these, the multiples here in the equity markets, both in the U.S. and abroad, that we're going to have that recovery next year. Here we have the Business Roundtable, yet another view of the economy and the perspective on the part of respondents to their surveys. So when you look at this, you've got the overall economic outlook index, and you can see it's kind of tailing off a little bit here. You see the employment sub-index is tailing off at a greater rate. What that means is, the respondents to the survey are less optimistic about hiring and having open positions to fill. And so this is pretty consistent with the thought that's out there now that these higher interest rates are eventually going to slow the labor economy, even though, not tank it, but maybe just slow it. And so this data is very consistent with everything else that we've been hearing lately. Here we have the National Federation of Independent Business. This is kind of a advocacy group for small businesses, and this is their own optimism index on the left-hand side. It has been positive for about 4 or 5 months now, and then just took a slight downtick. You can see the trend line there. This is a trend that was established back in about the second quarter of last year, and we've been kind of like up and down, up and down. And of course, we're tailing off a little bit, but as you can see here, the optimism index clearly much lower than it was before the pandemic. Then you have the sales optimism on the right-hand side. And so sales being the mother's milk of future profits, you can see here that they're a little bit less optimistic on the sales front. And this is not, as you can very well see here, is not something that just happened. I mean, this optimism has been kind of tailing off for quite a few months now. Here we have more data from the NFIB's index and their surveys here. You can see employment changes took a little bit of a downtick. Again, very consistent with everything else we're seeing. Labor market slowing down a little bit. Job openings tailing off. So that's the labor side. I have one more chart on the right-hand side, which is the availability of loans. And this is kind of I'll call it a green shoot, if you will, is that after many months of significant credit tightening on the part of all financial institutions, we actually did see a tick up in the availability of loans. And that's not to say that credit is easy again, but it's just not necessarily as tight as it has been, which is certainly a positive if you're trying to engineer a soft landing. Here we have more data related to the economy and the health of businesses and things like that, and came across this from S&P Global Market Intelligence. You can see here that we've got in the upper left-hand corner, year to date through August, we've got 459 bankruptcies, and these are generally, as you can see in the graphic down in the lower left here, you've got private companies that are in kind of the middle market. level. So you have 459 bankruptcies as compared with 235 this time a year ago. So we've already exceeded the number of bankruptcies that we saw either in 2021 or 22. So just to show you that that number is picking up in the background, it's not something that gets talked about a lot. For quite a few months, I was talking about how credit, might be a little more challenged than it has been. There's certainly a lot of optimism and exuberance is priced into the economy right now, priced into the markets, I should say, based on, the better than expected economic growth. But just to bring this back full circle, that yes, there are some stresses in the economy right now, and you can see the industry groups on the right-hand side here, consumer, discretionary, industrials, and healthcare are the three areas that are exhibiting the most stress right now. Here we have market expectations for future federal funds rates, and these are the short-term interest rates that we talk about all the time. What is the Fed going to do? And right now, you can see that that there is call it about a 40% chance, perhaps, that we're going to get another rate hike by the end of the year, perhaps the last Fed meeting of the year, and you can see that that kind of tops us out at about 5.5%, and then through the balance of next year, we get some rate reductions, kind of ending the year at somewhere around 4.5%. So taking a full percentage point off of where we are right now, and that's again, these are estimates. Obviously the landscape can change and has changed, and a lot of the forecasts that were laid bare last year did not pan out. So I think we got to take this, a little with a little bit of caution. But I just wanted to bring to you what's being priced in the market right now. Here we have bank credit, and I told you a couple slides ago that it does appear that availability of credit from the NFIB's perspective has gotten better, and this chart is kind of a secondary affirmation of that. And you can see that share of management teams discussing bank lending now has gone down. So, what this is interesting, the interesting thing about this is not senior loan officer surveys or the so-called SLU surveys where, it's the loan officers responding to a survey themselves saying, yes, we are tighter, or no, we're not. This is a survey, or I guess, this is an assessment of quarterly conference calls where credit is being discussed by management. And so the long and short of it is that management is not as concerned with the availability of credit now as they were just a few months ago. Here we have payroll growth. We've got a couple of slides on this. This is just another way of representing what I've already mentioned. We've got non-farm payrolls that are in decline, and you can see the smooth 3-month moving average there, also in decline. So again, payroll growth is still positive. It's just slowing its pace. We're seeing a little uptick in unemployment, and you're seeing less temporary workers. We've got a slide on that. It's just, labor market's just slowing down a little bit, and this is exactly what is normal and expected, is exactly what the Fed wants to see. If anything, they would want to see it a little bit more accelerated, but in any case, the data is reaffirming the labor market, just losing a little bit of traction here. Here we have that temporary help services number that I showed you. Again, this has been rolling over for a number of months now, and indicative of firms that we're in a tight labor market. You tend to look at temporary help to kind of fill positions that you would ultimately like to fill on a more permanent basis, and then when you start to curb the use of temporary employment, it kind of indicates that things are slowing down, and it's kind of a precursor to in many cases a precursor to slower overall hiring period, that you're just not filling jobs. And that may very well be the case here. And you can see with the gray shaded bars kind of overlaid, how a rolling over or a reduction in U.S. temporary help correlates to recessions. And so, this is one of those indicators that you might look at, alongside the leading economic indicators to say, perhaps that, maybe we're on the eve of a recession, but that's certainly that's not what's being built into market pricing right now. This notion of a soft landing clearly is, but this is very consistent with what you'd see with kind of an economic slowdown here. We have labor shortages, and this is, again, in conference calls, as we talked about, and this is from Goldman, which does really good work on this stuff. It's just the share or the frequency of mention of labor shortages in conference calls, and you can see that that has come down quite a bit. So labor market, again, not as still in relatively decent shape. It's just that we're not really talking about shortages anymore. So companies are kind of pulling in, they're kind of standing pat. They're not necessarily, we don't see a big tick in unemployment. We don't see a big tick up in layoff announcements. We just don't see a lot of growth in labor right now. We'll switch gears here and talk about personal consumption, and retail sales, and the health of the consumer, and and whatnot. And this has really been the surprise story for 23, is that consumption has remained relatively strong. And you can see here in the data that we get from the Federal Reserve Bank of St. Louis that honestly the numbers are ticking up a little bit, which is not something that we would have ever expected in January of this year, but it has certainly transpired. Here we have some data amongst the income cohorts here on consumer spending, and actually this specific number here is retail store sales, and this is a composite of all of those retailers that you can see in the bottom note there. And what's really interesting is where the spending growth is coming from, and it's actually coming from the lower income cohorts. You can see here that the middle and higher income cohorts have really trailed off, and so you've got these lower income cohorts that are still reasonably strong, to the tune of about 5% on a year-over-year basis, but it is decelerating, and so again, consistent with maybe a slowing in payroll growth, consistent with some other things that we watch that you might expect that retail sales to slow in the coming months. Here we have student loan repayments, and this is a big deal, like we started off with. And you can see here, this is Russell 3000 earnings call. So this is management's assessment of what how they're exposed because of the student loan repayment issue. And obviously, this number being a lot higher than it's ever been is indicative of the fact that company managements are concerned that this is going to have an impact on their retail sales numbers for themselves, as well as the overall retail sales for the economy. Here we go with the younger generations in the blue lines there, and you can see baby boomers and Gen Xers in those kind of gold-ish lines there. But you can see that Gen Z and millennials have spent a lot of money on travel, recreation, dining out, and they've been spending money a lot at a much faster pace. And again, these are probably, to correlate back to the prior chart that we saw, that lower income cohorts are definitely spending more on a retail sales basis. And again, that's corroborated here. The younger generations are spending. And this is why the student loan repayment issue is such a big deal, because you are getting a lot of our growth and a lot of our strength in spending from these generations. And if they're going to be impacted by student loans, which takes away purchasing power, then you would think that the environment is apt to slow down. Now we talk about inflation. We monitor this on a monthly basis, of course, looking for inflection points. We've been watching this number come down for some time, and we've got two different representations of that here on this slide. On the left-hand side, we see the overall number in the gray line. It did pick up over the last month. A lot of that had to do with gasoline prices that have gone up. We know the energy basket's more expensive these days, so that was pretty well explained. That uptick was mostly explained by that. There are some other factors, but you can see the core number, which is in that kind of purple line, continues to trend lower. It's kind of hovering just above 4%. So obviously the Fed wants 2%. So we've got a long way to go for that. And I think as long as we have sticky energy prices because of the, I guess, the politics of OPEC plus and the supply of crude oil, how that's impacting all of the downstream pricing mechanisms, then you'd expect inflation gains from here to be a bit slower. But we will talk about at the core level, what really matters is going to be shelter. We're going to talk about that in just a second. And you see here on the right-hand side, the annual rate of change for the core. The good news here is that, there is traction building for a decrease. Again, notwithstanding the fact that you've got energy prices that are higher. But overall core prices are still moving in the right direction. They may be a little bit sluggish, though, to achieve the Federal Reserve aim here. And that's why, to the extent that it does take a little while for inflation to meander down to that 2% target, it doesn't give me a lot of comfort that we're going to get a lot of rate decreases next year. I think we'll have to see it in the data before we can begin to believe, to my earlier slide of the short-term interest rate expectations moving down a full percentage point next year. I think we're going to have to wait and see that in the data before we can really begin to expect that. And here we have the OER, the owner's equivalent rent. This is a major component of core inflation. In fact, it's 30 to 40% of that number. So it's very impactful. And rents have been high. They've been sticky. They tend to follow home price increases. And so we know what that has done lately. And so home prices have rolled over a little bit. And as we'll see, a slight uptick last month. So rents have been sticky, but they have come down. You can see that on the left-hand side. We also have data from Haver and Nomura Securities with their specific forecasts on where rent inflation is going. And I think this is fairly consistent with what's out there in the kind of the intellectual domain from all the investment banks and whatnot. So looking for continued deceleration in rent inflation, which will certainly help the overall inflation number get back down to 2%. So continuing down that path, we have more data on inflation. This coming to us from, again, earnings calls. You really learn a lot by listening to earnings calls. I've done it for decades, especially when I was covering individual stocks and listening to their conference calls. A lot can be gleaned from what management says and how they say it too. But in this case, we're just looking for what they're saying. And so you can see, the number of companies citing inflation on their earnings calls has come down. So inflation is less of an issue than it was just a few quarters ago. And you can see, from an industry standpoint, the ones that are really concerned with inflation, as you might expect, are financials. Where interest rates are very interest rate sensitive because their margins are very tight. Industrial, same deal. Healthcare, to some extent, and consumer discretionary from if inflation's high, purchasing power is less, then you tend to get less consumer spending, and so no surprise there. Now we talk about crude oil and the energy complex. As I've mentioned, we've seen a tremendous increase in pricing. You can see just from the end of June, we have had a tremendous increase in crude oil futures. Again, due to the dynamics in OPEC plus pricing, inventories, et cetera. And so these prices are apt to remain high. Of course, we're exiting the primary driving season, so you would tend to think that these, from a seasonal standpoint, should begin to moderate, but that's not likely to happen necessarily this fall. I think prices are going to remain high. Prices at the pump will remain high, and so that'll be something that we'll have to contend with. Here we have implied crude oil demand. Another key reason why prices are high is, frankly, demand is high, and that's a sign of an economy that's doing reasonably well, right? People are driving, they're enthusiastic, they want to consume, and so crude oil demand in the United States is picking up. It's not just from consumer needs, it's also for industrial needs and cracking and making plastics and all sorts of things. So demand is high, helping to keep prices high. You can see gasoline prices on the right. This is something that I mentioned. We've seen a tremendous increase. And again, this is something I think we're going to have to deal with, for the bulk of the fall. You can see that prices are kind of in the same band to a great extent as they were this time a year ago. Dollar is very strong. Now, we've seen the dollar, witness some, weakness at various points this year. It's really strong right now. In fact, it's had a fairly stout run, and it's not getting an awful lot of press. But I guarantee you it's being discussed in company boardrooms, particularly, those firms that are doing business overseas. So, when you have a high dollar value, that means that the value of your sales abroad goes down. And so it tends to pressure your overall sales growth number if you're doing a lot of that business overseas. One quick comment on the federal budget. Obviously we're in kind of a lack of a better word, kind of a pissing match amongst the two primary parties here on a continuing resolution. I think let alone a formal budget, but at least a continuing resolution that gets us down the road. There's just way too much contention right now over various things, including spending cuts on the part of the far right. And here's the issue that we're going to have to contend with, and this is one of those things that it's kind of like that slow, painful migration. When you're spending a lot more than you're taking in revenue, at some point, that's going to come to roost, and we're going to have to make some fairly, I think, meaningful adjustments in retirement age for the ability to receive Social Security. I think this is absolutely putting into play, which is already a part of the election landscape going into the 2024 elections, is the issue of tax cuts going away, sunsetting in 2025, and whether those are going to be extended, and that's going to be a big part of the GOP plank, is that they do get extended and made permanent. But these types of things are going to take on a lot of water over the next year because we're running these pretty strong deficits right now. Retail sales, a couple comments here. We've talked about that a little bit with the outlook, kind of looking ahead over the next couple of quarters. You can see that retail sales, again, have been better than we expected, with some exceptions, but certainly over the last several months, they've been stronger than we thought. And even you look on the left-hand side, the red bar represents the latest data. They were expected to be off, and they were actually positive. On the right-hand side, you can see in the black line is just the overall retail sales number. The blue line represents real retail sales. So that's, after you net out inflation, and that's actually still directionally moving ever so slightly higher. Here we have PPI in various reads here. You've got, that's a purchasing purchasers price index, PPI, month over month. It was actually running a little bit hotter than expected. So this is something that we were not expecting. We've had more decreases than increases lately, again, with overall inflation dropping. We were getting pretty excited about that. And then here comes this latest data point that was higher than expected. And, some of that had to do with energy. So just to be clear, producers are impacted by that energy thing as well. If you look at core prices, they were up about 0.2%, which is pretty much in line with expectations. And so, and if you back out trade services on a month-over-month basis, they were fairly close to being in line, maybe a little bit hotter. But again, overall producer-based inflation is still continues to trend down if you look at it on a year-over-year basis, which is that chart on the right. So you see that in the black, that number continues to come down, even if these near-term data points are maybe a little bit higher than expected. Quick, some thoughts on the markets here real quick. Money market mutual funds continue to trend higher. Again, if you can get, anywhere between 5.2 and 5.5% on basically cash equivalents, that without taking on a lot of risk, why would you not consider that as part of your portfolio? And so, this is what's going on out there now, is that you still have disintermediation, from banks that are not paying on their savings or checking accounts, what people can get in money market mutual funds. And so that's why this number continues to go higher. Here we have equity sentiment, if you will. So a little bit, this chart that's going to require a little bit of explanation on the left here from Bloomberg and Macrobon. But, basically, if you have in that black line, it's the S&P 500 trailing 10-year return. So you basically take 10 years of data, create an average, and then every year you just drop off a year and add another one. So you get that moving average 10-year return. So you see that in the black line. Now in the kind of the blue line there, or aqua line, you see household allocation to equities. And so there is a positive correlation here that's worth noting. And you can see here that's being pushed kind of like 10 years ahead. And so the idea of this particular piece of research is to suggest that the S&P 500 is apt to not grow as fast as it has over the last decade because of this allocation issue. And so, if correlation holds true, then yes, then the equity markets are not going to be as strong looking at over the next 10 years as they have been over the last 10. And then finally, on the right-hand side, seems to, defy logic on occasion, but here over the last several months, we have had very little volatility as defined by the VIX. Very little volatility in the equity markets. In fact, we're back to levels that existed prior to the pandemic. We have retail investors and what they're doing right now. You can see that they're slowing their purchases of equities here, and it's something that began a couple of months ago. They were a big driving force behind the initial uptick in artificial intelligence stocks back in March after Silicon Valley was bailed out. So, but after that crest here in the middle of the summer, the retail interest in equities has waned. On the right-hand side, put-call ratio is moving higher. And so what does that mean? So if you have a higher put call ratio, that means the number of open put option contracts is increasing relative to the number of open contracts for call options. And why is that important? Put options are what you want to add to your portfolio if you want downside protection, if you expect the market to go down. And call options, conversely, if you're optimistic about the market, you want to own call options because that allows you to buy a stock or an index at a cheaper price with the expectation of it moving higher. And so basically a higher put call ratio indicates that the market is feeling less optimistic, that maybe that we're in tune for some type of a pullback and people want protection against that pullback. And just as we saw with the equity market, this is an indication of bond market volatility. And you can see here, at least as defined by the IEF, Exchange Traded Fund, or the iShares 7 to 10 year Treasury, that volatility on the fixed income side has gone down quite a bit too. This is an indication perhaps of just embedded complacency within the market. And we'll spend a couple minutes on credit as it relates to the health of business out there, and some very interesting things going on right now. Now, you've already seen a slide where small, medium-sized business bankruptcies have been on the increase. We see both the NFIB surveys that are kind of a little bit more somber, as well as the Conference Board surveys are decelerating. It means that, companies are, I think, kind of girding a little bit for an economic slowdown. And you can see here on the right-hand side, which is where I'll start here, is you've got interest coverage that is actually going down. And so what does that mean? That just means, let's just call it in a very broad sense, operating profits on the part of companies. The ability for company operating profits to cover debt service, to cover the interest payment back to the bank or whoever the lender is for that particular company, goes down. And so you are less able to cover that interest payment. And obviously, if you can't cover it at all, then you're in a default situation. And, that's not something that we want to see. But, clearly this is cyclical. You can see the recession bands that are kind of overlaid here. And so you typically see interest coverage roll over ahead of a recession. Now, it's not one of these 100% perfect indicators, so I don't want to get too carried away with it. I just, want to highlight the direction that it's going. So basically, the ability for companies to cover their interest payments is going down. Now, on the flip side, let's go to the left-hand side of this chart, which is really interesting, is that you would expect if you have increased stress, perhaps, of being able to pay your debt service back, then investors should be demanding a higher rate of return, and certainly relative to safer investments like treasuries or really high-grade corporate bonds. But that's actually not the case. We're seeing tightening credit spreads at a time where we should be expecting to see them kind of widen out a little bit. And that's been another one of those strange anomalies of 2023 that, I think over time will kind of play itself out. But right now, it's very interesting to see credit spreads tightening amidst a period where we're seeing interest coverage be a little strained. I have a couple of comments on the residential real estate sector. I'm actually been asked to talk a little bit about the commercial real estate sector and looking for some good data on that through some other publications that I look at periodically. But let's just focus on the residential market again here, just bring you up to date. We had a little bit of an uptick in home price appreciation. That's the HPA there. And so after a year of fairly significant kind of contraction, if you will. So home prices are on the march again. You see in the lower right hand, you've got the average mortgage rate, over 7%. It's kind of holding in there. So I think we've, we're far enough along in this tightening cycle now that people are getting used to the fact that mortgage rates are higher, and they're not necessarily as much belly aching over the fact that, well, they could have had 3.5%, a year ago. Well, that's kind of in the rear view mirror now, and so people are acclimating to this higher rate environment. But that has not changed the issue with regard to home affordability. And so as a result, existing home sales are really down. And in the upper right-hand chart, which I thought was really powerful, we've seen a consistent uptick in the percent of total home sales that are of new construction. And just talking with a builder last week, that they're offering buy downs of 3 percentage points on the mortgage rate as an incentive to buy new homes, because the landscape in the new home market is extremely competitive right now. Here we have some data from UBS. Sorry for the quality of this. I wanted to blow it up for illustration, but this is basically expected total returns. And as you look out on the left-hand side to next summer, and on the right-hand side, if you look out over the next 5 years. And what this tells you is these are aggregate numbers. So the 5-year numbers represent total, obviously not annualized. But if you look at over the next, call it 9 to 11 months here, certainly expecting treasuries. If you get interest rates that are moving down, then treasuries are absolutely going to perform well, as are most fixed income investments, and that's why we certainly have an allocation, and we're diversified. So we've got international stocks about 7%, alternatives actually pretty strong, and then cash rates about 5.3%. So if you look at over 5 years, looking at global equities, really strong return, but also alternatives too. And so we've kind of taken note of that. Cash will obviously be positive, but not expected to be as strong an influencer as it has been over the last 12 months. And then global bonds there too. So diversified portfolios are basically the takeaway from this slide here. Some information from Northern Trust, which I thought was pretty interesting. If you look over the next 10 years versus the last 10 years, expecting lower total economic growth. And I think it helps to be conservative. Again, this is just Northern Trust numbers, and everyone's a little bit different, but I think the general consensus is that growth over the next decade is not going to be necessarily as strong as it was over the last decade. And you can see that differentiated here between the green bars. You see the U.S. at average 10-year real gross domestic product, or GDP growth rate of 2.4%, expecting next 10 years to be about 1.8. And same goes for all major economies, especially China, which we've talked a little bit about lately, that is its own growth funk right now. Well, switching gears, this is Northern Trust's assessment of future returns for various sectors and relative to the last 10 years. And again, kind of like the economic backdrop, they're expecting slower overall returns for the various asset classes. And so, I'm not here to disagree with this. I'm just saying that this is the conventional wisdom out there right now, that over the next 10 years, you're going to get much better performance out of the global aggregate bond market, U.S. aggregate bond, basically fixed income in total, relative to equities. Now, that's not to say that bonds are going to outperform equities. It's just saying that the contribution of total return from bonds is apt to be higher over the next decade. So that puts a premium on adequate diversification, and wanting to make sure that you have exposure there, because as you can see here, the impact from equities overall is expected to be not necessarily as great over the next 10 years as it was over the last 10. It's a lot of data, kind of getting caught up over 2 weeks here, but I hope you've enjoyed it a little bit longer today. We'll try to keep it a little bit shorter going forward, but in any case, have a wonderful week and we'll talk to you again soon. Take care. Bye.